Good evening, participants. Thanks for taking this Friday evening to join this webinar. Today's webinar speaker needs no introduction as he has few contemporaries in handling multiple markets in different countries. I'm very happy to welcome Mr. Samir Arora, the founder and the fund manager at Helios Capital with close to about 30 years of experience. And he is widely followed in Twitter he has got about over 5 lakh followers. And from 1998 to 2003, he was head of Asian emerging markets at Alliance Capital, covering 9 countries. In 1993, Samir relocated to Mumbai from New York as the first employee of Alliance Capital Mutual Fund. And in this assignment, Samir received over 15 prestigious awards, which includes S&P's AAA rating continuously for 4 years, And Samir is an engineer from IIT New Delhi and IIM Calcutta, and he is a gold medalist in IIM Calcutta. Samir reads a lot and he is a vociferous reader. He likes watching movies and attending live sporting events are his hobbies. This is not a regular webinar where a fund manager will talk about the strategy followed by a Q&A. This webinar will have no product presentation, as I think it is an opportunity for all of us to learn from a man who has seen multiple markets over 3 decades. And I would like to start the webinar. Sir, please have few words, then I'll come to the Q&A.
Well, thank you very much. I just wanted to say that I am the fund manager for Helios Capital Singapore, not Helios Capital India, just to clarify, because this webinar is going into India. So thank you very much for the introduction.
Sir, we have about 10-12 questions for next 1 hour. I'll get into the international. After the 75 BPS increase by Fed, 75 has become new 25. Okay, and
correct.
23, the Fed is going to continue the increases. And do you think they are hawkish? What is your assessment?
Oh, no, clearly they are hawkish. Not only they are hawkish, their language is very hawkish. And actually, they have been hawkish for quite some time. I think it was in Feb or March, I think Feb, that I saw a video of Chairman Powell talking to either a Senate hearing or a Congress hearing or something, where they were asking him that will you take draconian steps, if required, to control price stability. That was the word they were using for inflation. And instead of saying yeah, not yeah, he says, let history record that my answer is yes. And from that day, I became negative and I went on TV saying that we have never seen such style, almost like a Game of Thrones dialogue. Instead of saying, yes, but it'll be difficult, I have to manage this, that, he said, let history record. And the thing is that this time, it's like a loss of credibility for the Federal Reserve if they keep saying that we are going after inflation and we are going to do draconian steps or whatever. And the market says, no, you won't because you are too cute, that you will back off, that in the end, you never do it. It's like a father criticizing or shouting at a kid saying that don't play at the dinner table or I'll slap you. And the kid saying, no, Papa, you love me too much, you never do it. And that time he will definitely get slapped. So this time, after this Jackson Hole, this thing, when the market fell 4%, that day, I think there are 15, 16 of these governors, and one of them is Neil Kashkari, an Indian sounding name. So this guy gave an interview saying that I'm very happy that the market has taken cognizance of the speech, effectively signaling to you that they want the market to be down, because if the market, that is the US market, is not down, effectively it is like saying that the financial system is saying that you don't have the guts. And this time they are hawkish beyond limit. But I still think that this will play out very fast. As in, the typical bear market, if you just type on Google, you'll find somebody saying it's 300 days, somebody saying it is 16 months plus minus. So you could start from October, November last year and say already 11, 12 months are over. Secondly, the typical fall in a bear market is 30-35%. And that is if it is like a bad bear market, unless it's like a financial crisis type of a bear market, which was say 1929 or 2008. But otherwise 30-35% is okay. And in that, right now the S&P is down 20, but the Nasdaq is down some 26 or 27 or whatever. And we have 2 more hikes this year. And we have whatever number of inflation numbers coming out this year. So if in the next one, and the numbers coming before that hike, and then there's another one, it will all play out very fast, because these days these markets don't wait for 9 months to discover that what they said this year is bad. So I am thinking that, which I've been saying for at least 3-4 months, basically in December, it's either falling more or not falling more, or discounting or having already discounted, but mostly it get over by then. Unlike different previous times, I don't think this time the US market will start rallying immediately after that, like it does say in 2009 March, it suddenly goes up, or after 2002 it went up, because after a fall, when the market rallies, it is because immediately to save the market or something, the interest rates are cut or some liquidity is injected. And this time that is clear that it's not happening for a year. Maybe it's not happening for 6 months, but at least it's not happening next day. So it's not that if in by December the market is out, say, another 5-7%, which would take you somewhere in that range. It doesn't mean that next day the US will be, Federal Reserve will be panicking. So it is higher for longer. But still, most of the thing will be out, I think, by the time 2 more hikes happen, because they are basically in this quarter itself.
The next question is, Russia's war is causing tremendous human and economic hardship, has already taken a toll as inflation is going up, which is multi-decade high throughout the world. And the actions of Fed can result in soft landing by achieving 2% inflation target. In your assessment, how long will it take for Fed to achieve that landmark 2% inflation target?
No, they themselves do it. So I don't preempt them or go beyond them. They themselves are not saying it is reaching 2% before 24 or something. And even then, if you should, you guys to do real this thing should also see the actual press conference that happened after the cut, it's about 30-40 minutes. And there they were asking him that even in your projection, it never reaches 2%, it reaches 2.1%. He said it's broadly the same. But nobody's expecting it next year. And also there is no soft landing, I think now. Now there is a recession, because they themselves are saying, previously they used to say that we are sort of confident or somewhat confident that because the labor market is strong and because this and that the recession may be averted. Now he said in this press conference that that if it happens, it's a cost of doing business kind of thing, which means he was not even saying that if a recession happens, I will back off. Right now, the focus is on inflation. Actually, there was a book I read called $1 Billion Triage or something, which was actually in an interview with Warren Buffett of this fellow, Charlie Rose, which is a famous interview. You can see it. I tweeted that interview also. So in that interview, he had quoted this book, that he has read this book in COVID time. So I got it. It's a very good book. But basically that book is it was written that this fellow Powell in 2012 had gone to Bernanke saying we have to raise rates. And that time Bernanke was the guy and they never bothered. That means he actually is a bit serious. So don't think of him as any other Federal Reserve governor in the last 10-15 years who sort of, in the end, looked at equity market and to protect the equity market or protect asset prices. So nobody is reaching 2% easily. But as they say, credible evidence that it is going towards 2%, which means basically this core inflation, which is some 6.3 or something, should go to 5, 4, whatever. And then I still think next year US market will not fall, by the way. Because if you again type on Google, you can see that in years in which there is a recession, calendar years in which there is a recession, the US market does not fall, because it would have fallen so much this year, which is say 30%, and many stocks 60, 70%, that it may not rally, I think, big way for even the first few months of next year, but by the end of the year, it will be positive in 2023.
The new cult of investors are confused about soft landing, hard landing, mild recession, or deep recession. Can you throw some light on this? What is soft landing and what is hard landing, and the mild recession and hard recession?
Yeah.
The impact.
So the recession actually has already happened in the US, because recession was originally defined as 2 quarters of negative GDP growth.
Okay.
But then there is one more line, which is that the NBER or something, National Bureau of Economic Research in the US, has to call it a recession. So this time, I don't know exactly, but I think they haven't called it a recession, because they said unemployment is not there, wage growth is there, people are having a party, but technically it has become a recession. So therefore, this is not being counted as a recession. So when we say mild recession, even I don't know. By the way, guys, I have not heard these questions before, so don't think that I already know the questions that are being asked. But I would think mild recession means that it actually ends in 2 quarters, and maybe it is some 0.5%. Now, basically, nobody feels the pain beyond a point. So that would be a mild recession. But I don't know exactly what is the legal listing, if any, of what is mild and what is hard. It's like a market fall. Since I'm long short, a bigger fall makes me think it's deep. A small fall makes me feel there's no fall. So it's the same thing with everybody. Depending on whether their jobs are lost, they might call it a deep recession. If their friend's job is lost, they'll call it a mild recession. But it's just English words, and broadly you can figure it out. But right now the expectation is that it will be a mild recession, because most of the recessions are mild. And because the job situation in the US was so strong, and even now it is strong. If you see that press conference, by the way, you should always see that, because it's a 45-minute only, and all the questions that you ever think are already asked by Bloomberg and Reuters and all these guys. And there's nobody sucking up to the government, so they ask proper questions. So in that, so one of the sort of goals is to reduce the number of jobs in some sense, or the number of jobs per applicant. And then he also talks about another term which I had not heard before, called the quit rate or something. Like how many people are quitting their jobs. So they want that quitting should come down, that people should not be moving around because they think life is easy. And on US Cockbox, which is the CNBC, basically the commentator there, what's his name, Kramer, was saying that the objective of the Federal Reserve is to make sure that people work, because they have stopped working in some sense by saying, I don't go to office, I only work 2 days a week, I don't like this, I don't like that. And in a sense, implicitly, the system is revolting against that and saying, we will bring down everything till you go back to the old style.
And YTD, Samir, if you see, everyone are talking about decoupling, and 17-18% outperformance is there for India versus US now. Okay, and we all know that we were talking about it mildly now, as no social media like now in 2008. We all know what happened in 2009. Do you think with 2 months outperformance or year-to-date outperformance, are we really decoupled, and the long-term data suggests that we rhyme the US markets?
Yeah, so actually in my entire life, at least since I became a fund manager, which was 93, I don't think there's been a single year where it has been like this year, which is that the markets are going in opposite direction, and big opposite direction, and particularly India going up while the rest of the developed markets and US is down. But I still don't believe there is decoupling beyond a point. It is like saying that if there is a crisis or a death in the neighbor's house, we are not going to play loud music here. you might still have a small quiet party saying because it's my birthday or whatever, and I have to still do it kind of thing. But you don't make the noise and loud and obscene because it doesn't work. It is same thing in markets that ultimately the investors are also coming from there. And if they lose a lot, and in 2008, I was the big bull of India. And I used to, for every line, I would defend it. Since then, I realized, and in 2008, I lost because of that. Because any problem that happened, I said, no, India has no exposure to Lehman Brothers, and ICICI does not have this, and HDFC Bank does not. And HDFC Bank stock fell 52%, while its earnings were up some 30% in that year. Now I say no. We are all connected with via the concept of financial markets or equity. So, but I still am bullish for next year because I think US will stop falling. Because US, at least as of now, nobody's thinking that this is like a global financial crisis. And we don't need the US to go up to feel good. As long as it doesn't fall and then goes up down 3-5%, it's okay. But it should not be like this, that this month Jackson Hole and yesterday, I mean, what ridiculous thing to start a market flat. I mean, what are we trying to prove that we are some national? It's not an ego game. When the day before and the day before the US market is falling, and that fellow is saying that please look at my comment from Jackson Hole, nothing has changed.
Correct. That was
and we open up or down 10 basis points or something, just free money to people like us to short for no real this thing, except somebody wants to give a gift to the guys who want to short. But today, that way is a little bit of this thing. We cannot be totally isolated, but over the years, it builds up and we outperform. Just to give you some numbers, in the last 25 years, and which although this year may have a little bit of a role in that, but it's not going to change 25 years of numbers, the Indian market in dollar terms has beaten Warren Buffett.
Okay.
And Warren Buffett has beaten the US market by 0.9% per annum. And we as in the index has beaten Warren Buffett by 1.1% per annum for some 10.1% per annum in dollar terms. And this was till July and I had done. And Buffett is up 8.9 in Berkshire A in dollar, and the US market is up 8. So actually, ho gaya na, without us saying that we always followed, but in the end, it's a massive difference of 2% per annum against the index of US. So ho jata hai, but it should not be in the face. In the face will then bring more losses and things like today. So I say we will outperform, but we are not supposed to outperform 20% per annum. And that is what it is. And therefore, I think next year absolute money will be made because the US will not fall as much, or hopefully not fall, or maybe even go up 5-7%. And then maybe the following year, US market goes up when actually rates are cut. Right now, they are even on their dot plot or whatever they call it. There is no rate cut next year in the US.
Still one.
Plus one more thing. We are connected with one more way, which is that if their rates go up like another 1 point something in 2 quarters, 2 more sessions, and this 75 has happened, you cannot do anything. You have to raise rates in India, whether you like it or not, because otherwise the currency becomes like this. So therefore, India will have to, or RBI will have to increase maybe, 1% cumulative if they are doing 2. If they're doing 0.75, 5, let's say, and another 0.5 or something. So they would have done 175 in 3 months. Then we have to also do at least 1. So all these things are connected at some level.
At least 2 rate hikes are still impending now in the US. Do you think?
No, much more. Their thing is ending at 4.6. So 2 now and then maybe 25. But 2 cannot take them to 4.6 because right now they're at 3.
At the end of this, what will be the terminal rate at the US?
So they are saying 4.6.
All right. Okay.
And right now they are what they call 3 to 3.25. I think it means 3. So that means they have to do, and they are not going to do 2 more 75 straight away. Because, these things take time to convert to who lost, what happened. By the way, today in Wall Street Journal, there's an article that luxury homes in US are already down, sales are down 26% or something year on year. 26% already with this much.
Falling is okay. Yeah, the bar dancers buys multiple houses. That happened in 2008 with the problem. If that
I know that.
doesn't occur, we should be happy.
So
And
actually, one more thing, US will not have that problem because US, most of the mortgage is 30 year and it's actually 30 year. So a new guy cannot buy now, maybe at whatever 6% but the old fellow is not being changed. In India, the problem is nobody has a 30 year. It's 2 year or even 1 year or 0 year. It's completely floating. So any rate increase, immediate increase there, any rate increase doesn't matter to the existing population of guys who already got a mortgage and locked it 30 years, which is most of them.
investors, if you have any questions to Samir, please type it and send it to us. We'll be very happy to answer those questions. And I'll get into this next question. Do you think after this race, still money will go out of India? FIIs have come partially after 33, 34 billion being sold, 4-5 they bought, and mutual fund flows are good and the Indian market is not fallen. And given this, if they raise, the terminal goes to 4.6, more money will go out of India?
Beyond a point, I don't think it will go out because, there is an equity element which is basically driven by the fact that whatever happens, there will be, say, 2% GDP growth in the world. And therefore, it means some X% will be saved and then Y% of that will be put into equities by all these pension funds and endowments and family offices and high net worth guys. So first look at it big picture. In the last 25 years, how many years has FIS sold? I think 4 or 5 years. I think 4 years only. So their default thing is to buy. Their default thing is not to sell. This year's sales can't also be totally attributed to something specifically wrong with India. In fact, India has done very well, and maybe that is one part of the reason why people may have sold, because the other countries of which we are a part of that basket. So let us say it's mostly Asia or emerging markets. So mostly it'll be China and Russia and India and whatever, Korea, Taiwan, etc. So if that pool does badly, and this year we have not done badly, that pool has done badly because China has done badly. So because of that, if there might be an overall performance for Asian guys which is bad, and so somebody may take out, therefore you have to take out of India also. Second thing is that when I was saying that in the 25 years, for only 4 years, foreigners have sold. Actually, even this year and last year, the same foreigner wearing a different hat has put money into private equity and into VC and all that, venture cap. And it is the same guys. Because there are only 4 or 5 fellows who invest. Endowment, pension fund, high net worth, family office, something, is the same guys. It's just that they give us money for public market and they give somebody else money for private market, but the end investor has not walked away from India. In fact, in the first 6 months, I think 30 billion has come from these guys who type and see, and last year was 60. So it was the same rate, which was the private money, private equity or whatever money. So in that sense, I don't think anybody is walking away from India, and particularly not now. Also, you can look at it relatively. There are 4 or 5 places where money is invested in equities. US, Europe, China, India, put Japan or put some rest of the world. But we are definitely, Europe has lost more ground than we have this year.
Sure. Many
Many of their problems have been exposed. There's Russia, oil, gas, whatever. China has been badly hit because their GDP is now down to 3.5%, 4%, and their policies which were related to hitting companies because they wanted to achieve some national objective. For example, if you know, these guys had these education companies or tuition companies like our Baiju, and suddenly one day last year they decided that tuition has to be not for profit business because people are not having kids because cost of education is very high, and now they are following a 2-kid policy. So these edtech companies, which had market cap of up to I think $15 or $18 billion, One day in 2 days they fell 90% and now they're gone. Basically they're zero and over and have a nice day. It's not that they fell 50% and now you can find an indirect way of charging them tuition, have a nice day, gone. Then they did this with gaming. So they suddenly said that kids cannot play games other than on Friday, Saturday, Sunday. So then those stocks fell some 30-40%. Then they went after Jack Ma. So then Alibaba fell. Then they made many of these billionaires donate billions of dollars to some basically charity. Then this company Didi, which is Didi or Didi, which is our Ola, it went public in New York. And I think 2 days or 1 week later, they were raided saying that you have sensitive data about how this fellow goes to eat chole bhature. So this is very sensitive data of travel of people and it should not have been shared. Although nobody's sharing it, but the investor is a foreign investor now, so it should not have foreign ownership. So Didi went from 17 to I think 2 or 3 and it's been again privatized. So these are direct losses to stock market investors. Now where will they go? And US, although doing well, the Federal Reserve says that you are doing too well and I don't like it. And when the market is falling, they are saying we are happy that the market has taken note of the concerns or whatever raised by by the chairman. So therefore, India is relatively brilliantly placed. Absolute ke liye, you want the rest of them to not be falling every day. At least US. And in other context, you can say China also, because we are in this bracket. Europe, okay. So I think both these things will play out. They will stop falling. Maybe China will even go up a little because somebody will say it's very cheap. All these dumb guys will say. But I think we'll do all right. Because it was, we can think that when foreigners were selling 30 billion, the Indians bought. Now, plus minus 3-6 months, and it was shown in July and August that when they want to buy even 3-4 billion, so far the Indians will not give it back. So if you see in July and August, the market went up not so much because of buying, it was because of lack of selling, because the Indian crowd had just bought the stock in a bad phase. Why should it sell on day one? So I think India is okay. Now beyond that, who knows?
My next question is, after we talked about the mother market, and next is China. Are we writing off China too early? And do you think China is a monster, and being the second largest in market cap, do you think tweaking government policy is central committee? I think there are only 14 members. It can be done overnight there. Do you think they can come back quickly? No legislation, nothing is required. 15 people along with Xi Jinping sits and they can decide anything. Do you think we are writing off China too early?
Well, I want everybody to write it off early because I am an India-only fund. So I want to always blame China. But just one thing. For the last 25 years, in which India was up this 10% in dollar terms and 14% in rupee terms, and US was up 8%, and China's GDP growth was whatever it was, maybe 9%. One guess, how much was the market up per annum for 25 years? You can guess.
I don't know.
No, make a guess.
6%, 7% CAGR?
1.2% per annum, 25 years.
Oh God.
So therefore, one more thing, please remember that this is MSCI China, you can check. Main thing is that don't get overly carried away that because our GDP is growing 8%, our market will grow. That is also required, but you need these policy things. So China has been a disaster for stock market investors. Absolute disaster. 1.2% per annum for 25 years. Now, I'm not writing it off, but I tell all these investors who ask me, because I always pushing India, saying that you bloody should be ashamed that you want to go into a market where you keep saying we like stocks, we are equity, we are bottom up, and then the market will be decided by the guy at the top saying now we are supporting markets, now we are going to favor markets, now we don't like markets, now we want this shared prosperity, now we don't want, and you go in and out on that basis. And now the new formula for all these investors there is we will invest in areas which are aligned with what the government is favoring. So we will invest in green, this and that. How can the guys in the US who think that they are, buying equity and not, like they keep saying, we don't look at economy, we don't look at this, we look at stocks. Half the crowd is that, right? So how can you be totally driven by this, what the government said? But one more thing is there, which I strongly believe, that currently everybody in the world, not everybody, but let's say the US, thinks that China is not an emerging country, it is a competitor.
Okay.
That makes a big difference to the boards, to at least the Republican boards, which might be 50% of the country, they may Republican, 50 Democrat, who are very thinking that everything that they do is helping. I mean, if they go into China. India, the good thing is India doesn't act tough. India does not claim territorial this thing that I want to expand and take back Pakistan, take Sri Lanka, take Bhutan. You don't do all that. So India is not viewed as, we are viewed that we want economic success and health, whatever, prosperity and whatever for the public. But it's not that we are your competitors. On the margin at this place, nobody will go out of their way to help. But if their returns are good, people will come back because financial guys are, not bothered beyond a point. But I keep stressing this, that you can't go into a country only because you think now the government or whoever has said we will support financial market. What the hell does that mean? This was not even one of the factors when you do stock, this thing. You were supposed to buy cash flows and this and predictability and all that. Not that somebody saying, I will take the level up, take the level down. But they will do it. I'm just saying from my side, that is how I present it. But people will come. But still, big picture. China weight in the index of emerging market is some 30%. Okay. India's weightage is some 12.5 or some 13%. So next year, do you think that people will put 30% into China? I don't think. Let us say they put 27%, 25%. It is still a very large number. But that 5% which they don't invest or 3%, हमारे लिए उसमें से half changes our number to a 20% growth, because we are at 12. When you make it 14, it's like a big number for us. We don't need so much FII flows. We need 20 billion, which is not a lot. I mean, individually funds are managing 10 billion. We can't 20 billion. For India, a little bit of flows are enough and little bit will come plus minus a few months.
Do you think the current 12-13% of MSCI is justifiable? And what should be the ideal one, given that we are the largest, fastest growing economy in the world?
No. Index is not determined by fastest growing. Index is determined by weight. The negative thing in the MSCI index is that they look at free float.
Okay.
Not at float or not at market cap. So India's problem is not anything else. It is the free float factor which is used by MSCI. Otherwise, Korea and Taiwan have a GDP which is much lower than ours, a market cap which is much lower than ours, and their weight is not much higher, but Korea is 16-17%. By the way, when I became an Asian fund manager, which was in 1998, then Samsung Electronics weight in the index was higher than India's weight. Okay. So over the years, it has increased. But this, for example, just to say, MSCI in 2013, the number one company in the Indian index was HDFC Bank with a weight of 7.5% or something. Now it is 0. So when it was 7.5%, I don't remember what India's weight was, but let us say it was 10-12%. Now it is 12, so maybe it was 10. So that means we took out 7.5%. So 0.7, we would have got another 0.7% weight or something if only HDFC Bank had been in the index at that time. So for us, the issue is free float, nothing to do with attraction, nothing to do with people. Like I saw these ridiculous articles a few days ago that India's weight should increase because India is better than something. Nothing to do with better or worse. That is what index means.
Okay.
Market cap, but free float weighted.
Samir, we'll come to India now. And you touched upon on this, and RBI has got no choice other than
Increase.
increase rates, and they have no choice now after the 75 BPS increase in the Fed. And RBI has done a remarkable job in several interviews. You have also admitted this, and they have done a very good job. Given this, after impending increase now, what will be the cascading effects in the stock market for an Indian investor?
So first thing is that we have a current account deficit every year of about $100 billion, some 3% of GDP. So now we need $100 billion. Usme 50-60 come from FDI or 40-50, this at the private equity. Now you need 40 billion. So the whole fight is for 40 billion a year. If you don't want to increase rates, you have to get dollar from somewhere. So the other way is take it from the NRIs. Like it was done in 2013, give an obscene return, everybody will come and give 35 billion in 5-6 hours. Then you cannot, then you don't have to increase rates. But right now they are not in that mood because they feel that it might look like a sign of, I don't know, desperation maybe or something. So they have to raise rates. So if they raise rates, first thing is that all the things which are rate sensitive, as we say. So we have reduced, we used to have 2 stocks in real estate. We have made it 1 just the day after Jackson Hole, saying this cannot work. We can keep saying everything, but you look at the actual cost of these things really spirals when, you know, like right now, I think Indian mortgage is, I think 8%. It can easily go to 9. Pehle bhi to hota tha. It's not some obscene thing. Some of these things are a bit, not literally to one sector or the other, but they sort of act on the economy because the marginal fellow will put money in US fixed income and not come to India, and the marginal guy in India will take fixed deposit and not equity. All these things change a little, but obviously equity market valuations and everything are totally affected by interest rate. But the direct sensitive ones are mostly the, guys who buy things on EMI. It's sort of, which is whether it's a house or expensive things or cars or whatever.
To cushion the rupee, RBI has already spent 90 billion is what
Correct.
From the records I see. Okay, and rupee at 80.96 now, rupee dollar, and it has breached a key comfort level of 80. Where it could go and what impact it will have on the markets?
So first of all, actually, the way we tell the foreigners is different what I'm telling you. We say Indian rupee has been very strong this year. It is the dollar which is the strong, and India, what I'm saying, India's weakness is not because of India, actually the US rally because of their rate hike. And secondly, if you look at it compared to every other, not every other, but most other currencies, you look at it against yen or pound or euro or whatever, even China, India has done very well, even in the currency. But because everything has depreciated against US dollar, then even this 80 has been crossed. So right now, we don't make much predictions, but broadly all our life, we have been hit on annualized basis by 4.5%. So when it becomes 9, then next year it doesn't go, or it goes for 2 years. So we don't know. Broadly, longer term annualized, we will always believe it is 4-5% that we're going to lose till one day we don't. But we don't know. Right now, who knows? If it is 81, we'll say 82. If it goes 82, we'll say 84. But nobody really knows because these things are beyond our day-to-day job.
The next question is on the growth estimates. And most of the large international institutions like Moody's and the Goldman Sachs and Citi, from about 8.8, they have all come to 6.7 to 7.2 now. Where do you think we will settle?
We don't make any number on our own. We read their number, and wherever it looks more logical, we adopt it, because we don't sit here and make GDP numbers. I don't even know how GDP is calculated exactly because I don't know, such a big country, what they do. But we will also go with 7 because it looks in today's context a decent number considering that the US might be in a recession. But I have no idea, and it doesn't matter to anybody. These things don't matter. Interest rates matter. GDP is okay because we'll say we are buying this part, which is not so much to GDP. It is a penetration increase. This is unorganized to organized. Some story will be made to say that our fellow is growing some 15% or 10% or sometimes 25%, mostly to do with competitive situation or penetration increase or public to private or unorganized to organized, but the whole GDP won't play a big role in that. So, but it'll be in this range. But beyond that, it will not matter to our returns. As I said, China grew whatever 8-9% per annum for 25 years with returns of 1.2% per annum.
That was surprising, yes. Sir, the next question I'll get into. Helios is going to launch a long-short strategy at this interesting time. Which sector offers the best investing opportunity for long-short in your mind? Even though if you're not a fund manager, and can you throw some light on this?
So I've been a fund manager of the offshore long-short fund for 17 years. And it's not one sector. All the time, somebody is doing well, somebody is doing badly. Just to give some numbers, that our long-short fund has beaten our long side, while the long side has beaten the market by some 5.5% per annum in the last 11 years. And why I'm saying 11, because before 11, we did not have a long only. Before 11 years, we've had a long only thing. So the shorting has, in our case, has been to give protection of only 30-40% on the downside. So the objective of our offshore fund, which the Indian fund will copy, the objective at least, is that we are not using long short and in the end saying that we have underperformed the long onlys because we short and therefore we give protection and that insurance costs money. But that it should be in line or better and therefore providing insurance for free. Because normally in the US, what happens is that the stock funds that have 60% exposure will mostly never dare to compare themselves with the long only guys and the index in the long term, because the long term markets are up. So the question is, if you are bullish, why does long short make sense? That question, I can tell you one question, this thing just to prove that if I was to ask you that the market is guaranteed to go up 100% in 2 months. So that means 100 will become 200. Which strategy will you buy? A strategy which is 100% long or a strategy which has 60% on the net exposure? And we are not assuming that therefore this fellow will do better short or better long, but it will get 60% of the returns, but with monthly re-rating. So which strategy do you think is better? You are guaranteed 100% return. I mean, the market is going up 100%. Let us say we know in advance. And the other fund is a 60% net fund with monthly rebalancing. So what is the answer? What will you take? Tell, sir.
We are interested in the local Indian long short.
No. I'm saying which one will you choose? Will you choose a strategy that is fully invested or a strategy that is 60% exposure with monthly rebalancing? I'm telling you upfront that the market is going to be up 100% in 2 months. And 99.99% will say, obviously, we'll take the long only strategy because 100 will become 200. And the answer to this question is, it depends. So let us say 1 became 10 in 1 month. And then from 10, it became 8 in the second month. So that 1 became 2. Sorry, 10 fell by 8 or 80%. So 1 became 2. Okay, 1 became 10. And then 10 fell 80%, became 2. So 1 became 2. If you do this with 60%, that means you are exposed 60%. Then you rebalance, then you fall 60% of that, you will get 3 point something. Point being, if the market is very volatile, even if it is up, and we show it in our presentation that why long short is better. But anyway, when you get it, you'll see it.
In this long short fund, will you do with the index or stocks, and how do you identify ideas here?
No, so only stocks, except around some times of events we do index, at least in the offshore fund. They will do more or less the same thing. So for example, around budget time, if suddenly, in 2018, the capital gains tax was introduced, then in like 10-minute period, we reduced our net by 25%, shorting some hundreds of millions. So these things, then you need index. You can't do that very fast with stocks. But in most of the 17-year history, there will always be 15 to 20 short stocks and a little bit of the index or a large part of the index for some time if there are events like a COVID time or this time, or when this Federal Reserve fellow gives something, then that time within 1 minute you cannot do stock.
Yeah, I am coming to the running strategy of yours, the India Racing PMS, and what kind of changes have you made or your counterparts in India have made in envisaged future changes which are going to happen?
So Dinsha Rani should answer this question, but broadly speaking, as a firm, we have reduced our IT exposure to ZERO. And now, because I was all my life an IT bull, and we even had an IT fund and all that, and we made all our money in the first round from IT. But the thing is that there are only 100 rupees. If you don't have it in IT, does not mean you put it in a bank account. You buy something else with it, and we have bought consumer and financials with it. Now, somebody can say that IT has fallen enough. So maybe it has, but I don't think it's going up a lot. It is still higher value than it was pre-COVID. And the earnings growth, Goldman Sachs recently brought it down to 6%. Yesterday was Accenture results, and these guys were growing at 22%, and their guidance is for 7-8%. I don't like 7-8% revenue growth because my GDP of my country will grow at 8% or 7%, and many stocks or revenues will be higher, maybe 15-18%. 7-8% is not what we buy these complicated things for. So, and also I still feel that the US economy and corporate and market will be under pressure, and therefore these things will be under pressure. And the best is Accenture, that from 1 year growth of 22, they guided 8, but good credit to the Indian fund managers today who made it massively outperform. That is the tech stocks today, thinking that 8 is very good. No, my standards haven't fallen that much yet.
One observation and the next question, Samir. You are an eternal bull. I have seen so many videos of you preparing for this call, and I found you are always bullish on IT. Now you change the stance, and shocking to know that you have zero exposure now in your PMS for IT. After correction of say 25%, is it a contrarian bet now?
No. Maybe last week, 2 new guys have downgraded IT. One of them is Goldman Sachs, I remember, and one more I forget, but one more has also, for the first time, downgraded. And we were not zero for the whole year. We reduced some in Jan, Feb, when this Federal Reserve language came, and then later, just before and around Jackson Hole only. So we saved only 7-8% in this new round. Right now, the thing is that it doesn't matter beyond a point whether it's IT or not. The point is that we are not investing it somewhere else. So it has gone into other things. So even if IT does well, plus minus a few, the rest of my market will also do well. And I think it will be in line or better. But I want to have some clarity and visibility. I am not interested in, I am buying this for 24 and 25. It doesn't take me that long to go from here to there. This whole story that in the long term, we should have it. Long term, when it comes, we'll be there. But first, let's worry about 1 year and 9 months. Or if we can get a 10% performance difference in, say, IT versus something else. In that sense, you've already got 5-6% because the rest of the market is not really down this month. But I think we'll push our luck a little bit more, at least for another 9-10%, then we'll see.
I was reading a book called 2030, okay, and 60% of the world population will live in urban areas by 2030 as per the book. It was a very interesting book. I wrote a review, and I'm connecting this with per capita of India about 2,100. And you are always bullish on urban luxury consumption as a theme. Okay, how are you going to play this? And with 2,100 growing fast, how are you going to play it for next 2-3 years and the longer run also?
No, so first thing is we are not playing the 2,100. That is what we are saying. We are not playing the billion.4 consumer stories, which is where this $2,100 is. We are playing the urban consumer, which is much higher than 2,100.
Obviously,
So
yes.
it's like saying, so we are playing urban and not luxury. We are playing urban under penetration or middle class under penetration, not India under penetration. Which means for any sector, please don't tell us that it is only available to 700 million people, but actually we have 1.4 billion people. And this has been repeatedly done in the past. It's not that, for example, many of these guys, most in consumer staples or telecom and all, would use a 1.4 billion denominator, which I find ridiculous because of the disparity of income and all that. But I don't want to play India's growth. I want to play a penetration increase within India growth, and that penetration increase is easiest to see if you can compare it to other countries. So for the middle class, which is 300 million, you can say in other countries it grows like this, it happens like this. Otherwise, everything will look super attractive in India because you divide by 1.4. We don't have enough mutual fund, we don't have enough wealth management, we don't have enough this, we don't have even toothpaste maybe, but we say no, divide by 300 million. So for us, these stocks in today's context of what we have been the hotel stocks, the Vedanta, the ethnic wear, campus shoes, Zomato, McDonald India, which is that Westlife, Varun Beverages. So all these are middle class underplay, but not India underplay. They are India underplay also, but we are not even going to that India yet. We are just saying in the 200-300 million, it can go on for many years. And then one or two will then disappoint along the way, and then they'll be thrown out and somebody else will come in. But otherwise, these are the big picture, what we call low ticket consumer.
It is, I have understood, and it is not urban luxury. It is actually urban consumption is what you are talking about.
Yeah, urban under penetration, as we call it. We even although we don't have it. We have it. Sorry. Ivanova fund, we don't have it, but we even consider IFL wealth as urban under penetration because wealth management itself is an under penetrated thing relative to the world. Yeah.
And changing your traditional stance on the PSUs, you have added few stocks of recently of late. Okay, and what is your outlook? And are you playing the basket like PSU banks because legacy issues are behind them and NPAs have come down, or on the defense, or you are playing any theme?
So
specific stocks.
So our big picture is that we don't like PSUs.
Okay.
But then over the years, we realized that, just because in 96, because we are running with the same slides in 1997, 98, if not 96, that basically just because in 98, I said that I don't like PSU doesn't mean it is rejected as a theme. So then we made it in the last 10, 12 years that, okay, if we don't like the theme, but there is something special about that stock, then we override the theme. But then the analyst or the fund manager has to say, कि भाई ये theme को छोड़ो, it is better than the theme. Just because it has a label of a theme, ignore it. So we bought State Bank in 2020. It had become 0.3 times price to book, and its subsidiaries are very good, blah, blah, blah. So we have it in this PMS and we had it in our offshore fund and everything. And then we bought Bharat Electronics, saying that one reason we don't like PSUs is because we think that the private sector will come and compete, like we saw in wherever our successes were in media and telecom at that time and financials, that it is not being competed with. So why can't it is not? I mean, from one angle, that issue of not liking PSUs goes away. And because defense is doing well and government is giving orders and they are keen to have them replace some of the imports and this and that, so we bought. We will never, I think, unless we find another story, ever buy some 3 PSU banks in our life. It is either you buy State Bank or maybe Bank of Baroda, or you don't buy. But we are not going to analyze PNB and Central Bank and whatever bank. We don't even want to know how much is price, what is its book value. We don't want to know anything because we have many other things to do in our life.
I want your input on this. By 2032, there is an estimate women will control 55% of world wealth, is what one report says.
Sorry, who will control?
Own and control. Okay, both 55% of the wealth. Okay, and but women are not widely in the markets now. Or are you doing as a veteran in the industry? Are we doing something to get women into this attractive asset class?
Well, we till 2 years ago were not doing anything other than by giving lectures on CNBC because we were only an FII. And then only about 2020, we started this the MSCI. Now that we got a mutual fund license, there'll be more sort of on the ground listing activity and employees and all that. But I have not thought of it like that because so far we were not there in that sense, facing it or doing it. It is a good idea, but maybe in our mutual fund, we'll think of something. Right now, we don't even have enough people that way to, do special programs. But in general, just to tell you, my daughter has zero interest in the market and ZERO. She likes marketing. So if I could convince her, I think these things are a little bit self-motivated. But I think women should learn about financials so that they're not taken advantage of, which is different from saying that they should invest in equities of their own or not. It's more a matter of interest. But the education at the first level should be that you're not cheated by your husband or anybody else. And in terms of knowing what is the wealth of the family and what is the sources of income, and not everything is kept away from the women. But our business, we are not able to convince half the men also yet. I haven't thought beyond that yet.
And on behalf of PMS Bazaar and the investors who have joined this, I want to congratulate the team of Helios for getting the license to do mutual funds. It would be a wonderful journey, and all the best to you and your team. I'll get into the next questions, okay? And the market is unbelievably volatile now, and there's one-day swings. I have never seen this kind of a swing. I'm also there for some time in the market.
Correct.
What is your input to the current investors to stay in the sidelines or to top up or come out of the market to wait for a better opportunity?
So the general lesson has been that coming out is not so straightforward, but you can plus minus a little bit delay your entry if you so desire. I mean, not today, I'm saying in general, that is more easily doable. But if you look at the big picture, the Indian market in rupee terms has given basically 14% per annum since I have started, which is 1996 agar aap domestic fund se kare. So during this time, every problem that you are imagining now, 10 times bigger we have seen while this 14% market return was. My return was about quite a bit higher, maybe 11% per annum higher, if I take the 25 years. But anyway, usme everything has happened. Asian crisis, Russian crisis, global financial crisis, attack on parliament, 26/11, 9/11, demon, COVID, lockdown, some droughts, Kargil. So point is, in the end, you realize, we should never have thought of anything else. But we are fund managers. So if somebody is giving money, he said, should I put one time? We say, no, take 3 months. Take a STP, just so that it reduces our pressure also. And at that time, we feel genuinely that 2-3 months are very uncertain. Why make a guy invest right now? So that is the only difference. The difference between me and others is I acknowledge the market and say, okay, take 5 months, 3 months, doesn't matter to you or to me. The other fund manager will say, hi, my God, if I say it in 3 months, he will think I'm bearish and he will not come back to me and he will go somewhere else. And therefore, I will lose a customer. I don't do other care for all that. That is the only difference. There is no way that, okay, don't invest for 1 year. ऐसा नहीं है. Because actually also, best is look at right now on your other screen, average duration of bear market, average extent of fall. Then one Google one will come where it will give you all the bear markets and their years. Then you leave out some 1929 to 38 wala, which was the first global financial crisis. There was no SEC, there was no liquidity injection because SEC was formed as a result of this. And then global financial crisis also looks a bit wild. Baki dekho, it will be this percent, 28, 30%. Then you see duration of fall. It will come out to be some 8, 9 months. Somebody will say 12 months. Somebody will say 9 months. There are different ways they have, bracketed the different bear markets. Mostly it is getting done. Then, okay, if you want to do more type, number of years in the last 25 years when the market has fallen 2 years in a row, then you will find some one instance, which is mostly, I think, 2001, 2002. But in 2002, while it was trying to go up, September 11 happened, but boom, again it went down. So mostly you'll find that the bear markets don't last very long. The fall can be big, but they don't go on forever. And in 2002, because it got dragged for one of a longer, some 2-year type bear market, you saw what happened after that from 3 to 7. It was like whatever, everywhere in the world, not just in India. So it's broadly okay to be always invested. But if suppose today you want to put new money, I don't mind if you think for yourself that, okay, I'll take 2 months over it. It's not going to change your life, but it'll make you feel more in control of what you are doing. And that is why we say to everybody, please invest over 3 months, 4 months, doesn't matter. It won't change anybody's life, but you will feel better in today's context.
I'll take a couple of more questions because we are
okay.
We are over 1 hour now. Okay, and demat accounts have crossed 10 crores in India. Okay, and in the US, 90%, 80 to 90% buying in the market are by the institutions, and in India it is not 90%, but 60-70% is bought by individuals without any guidance from any fund managers now. Okay, do it yourself culture is catching up. What is the flaws in this? Why a guy requires a fund manager like Helios?
Well, like Helios, everybody requires. But why do they require a fund manager is because the retail guys are not even calculating their NAV according to me properly. And the best example for that is this Zerodha fellow tweeting. He can see accounts of whatever crores of customers, and he said some 1% people make money or even beat a fixed income return. I know for sure, for 100% sure, that when people say I made this money, that money, I say no, tell me you had this levers from 5 years ago. You didn't count that in your returns for last year. He says no, levers is my purana stock hai. That to my granddad had bought. That to my father bought. There to I'm getting dividend, which is more than what my father paid. I said, sorry, we are looking at your entire equity portfolio for the last 1 year and saying whether you beat the market or not the last stock you bought or the last stock you traded. Simply because it is very simple arithmetic that the market, if it has 70% individuals, all of them cannot beat the market. 30% will beat, 30% will be beaten. But in a mutual fund also is the same thing. Half will beat, half will be beaten, or actually 40% will beat and 60 will be beaten. I just think by looking at what Zerodha guy is saying and other guys are saying, that when it's retail individuals, it will be that some 5% will make a lot of money and 65 will lose a lot of money or lose money, maybe small money relatively. In institutional, it's a bit more even. It won't be that one fellow just taking it all away. In the individual, that can be the case. But the reality is that if the fee is fair, You can track, you can blame, you can criticize the fund manager. You can't criticize yourself. That is also worth 0.5%. Then you can call your fund manager an idiot if he does badly, but you can't do anything when you're doing it yourself. It's each fellow's this thing, or you can see the track record. I say see everybody's track record for 25 years. Nobody has 25 years track record except me.
And Samir, you have taken us around the world. Okay, and I can proudly say my daughter, I have spoken to Samir Arora today. Okay, it is a privilege and honor to have you, sir. And I want to thank all the participants also
Thank you very much.
for joining this webinar. Thank you, Samir. All the best for your team. And thanks, participants.
Thank you.
Thank you. God bless you.